The VIX breakdown continues as US equity markets make another all-time high. Rates implied volatility stays elevated ahead of key inflation and macro data this week. And emerging markets show signs of stress as COVID mutations run riot. All this and more in this week's Macro Insight. All right. Okay. Welcome, guys. Welcome back to Macro Insight. Today is the 13th of April, and let's have a look at these markets. All right. What's been going on? Let's have a look. So equities kind of continuing their march higher. It does feel like the last bears are really throwing in the towel. You know, there's a few macro commentators that I sort of listen to, and they're generally cautious and bearish on these really high valuations, and they're always signaling, you know, what is wrong with the world. But even they're starting to just accept equities never go down, right? So it seems like, you know, the last bears are really throwing in the towel. You're getting some signs of that. Let me share my screen. So bring up the S&P chart. I mean, there's one word to describe it, really. And I've said that's bulletproof. Yeah. I mean, you look at that chart, literally over the last week, not a single real pullback. And we're just kind of hugging along that upper Bollinger Band area. I mean, we had a little blip today, driven by the news hitting the tape that the J&J vaccine is getting pulled by the FDA because there's been some blood clots and some deaths and things like that. But ultimately, they've still rolled out 100 million vaccines across the US from the other providers. And, you know, there's the expectation there that COVID's going to be a thing of the past, or certainly is not going to impact our lives quite as much by the sort of second half of this year. And that's not really changing on that news. So market pretty quick to get bought back. What else there? The NASDAQ printing a daily close, a record daily close. So that's kind of managed to even get itself back up there, back to its highs. And then, you know, really a few signs of complacency in the vol market, right? So put selling. All right, so and then you've got rates vol versus equity vol, right? So you've got the VIX, you know, breaking down to kind of new lows, not seen in like 13 months or so, versus the MOVE index, which is still stayed quite elevated. Yeah. So pretty much, you know, you're getting different messages from the rates vol market and the equity vol market. Okay. The VIX printed as low as 16-ish the other day. S&P realized vol continues to collapse. You know, we're seeing a 10 handle on the 10-day realized vol on the S&P. As I mentioned last week, the 1 year realized vol look back period, which basically, you know, looks back at the last year of moves. That's obviously dropped out some of those wild March swings from last year. And that is basically saying the realized vol over the last year has suddenly shifted down. And on the back of that, certain vol target, vol control strategies will have more risk appetite on the back of that. And certain funds will have VAR models that look at that sort of window and will allow them to take more risk now that those swings have moved out of the look back window, right? So these are all sort of things that have been going on and kind of driving risk appetite up and helping push volatility down and even markets higher, basically, right? You've also had consistent messages of reassurance from the Fed on loose policy. You've had call buying drying up from the retail crowd, and you've got institutions who trade derivatives becoming a bit more comfortable with selling volatility again, right? So one of the big strategies that blew up last year in March was the variance swap selling, systematic variance swap selling that was done as a way of selling front end vol to earn carry. Some people got hurt by those trades. They kind of stayed out of the game for a while, and now they're starting to do it again, right? So having spoken to some of the people that I know within the sell side still who see that flow is definitely back. You've also got institutions, if they put on any hedges against their long equity exposure, they're doing it via put spread collars, which are volatility selling structures. So just a lot of supply of volatility coming to the street via institutions, and then no real retail bid for calls to soak any of that demand up. And even on the structured product side, like I said, Europe has got structured notes that retail clients buy, and a lot of those notes effectively are selling volatility, and that volatility finds its way to the options market and as selling flow, basically, right? And that pushes volatility levels down. Yeah. You've also seen normally what happens is the front end of the curve goes first. So, you can see a good example of this will be if we look at the curve. So, the front end, the volatility surfaces, term structures of volatility normally look upward sloping normally. And it's because the front end is what gets sold first. When the market stops moving, people sell the front end because that's where they can earn the theta by selling short dated options. Okay. But if the short end goes too low that people don't feel like there's much juice or value in selling it, that's when they start attacking the longer part of the curve. So you have been seeing sellers of 1-2 year volatility, okay, and that's just like because the front end selling has just got a bit exhausted and they don't feel like it's worth it, so they've started to sell longer dated vol, and they've also started to sell skew, which is downside volatility, right? Again, so it's often the longer part of the curve and the downside are often the last things to go, yeah, and you're starting to see now people moving out the risk spectrum and selling stuff that is still a bit more expensive because the front end is just starting to get hammered, basically, right? And that's kind of what we're starting to see, yeah? So that's kind of what's been going on in vol. In terms of another interesting thing with regards to US markets is, this Russell versus NASDAQ spread, right? So that is something that I keep an eye on as kind of a proxy for the value versus growth trade, right? And we've seen, since middle of March, that has had about 11% pullback in that spread, right? And the rally in that spread obviously started back in September, but really started to accelerate in November post the vaccine news, yeah? So it's been having a great run. It's had a meaningful pullback or mean reversion, if you want to call it. And when has it had that mean reversion? It's had it right ahead of earnings season. Okay, earnings season's kicking off this week with the banks, but basically what you often see, I think I can't remember which bank it was who put out this data, but basically when the tech stocks outperform to this extent into an earnings season, you've got quite a high bar there, basically, right, for the tech earnings, and you've also got all the other sectors are likely to beat on earnings, right? Certainly earnings are going to look good on a year-on-year basis, you would have thought. But basically, you're likely to get a load of beats out of most sectors, I think. But the techs are going to have a higher hurdle rate, right? So for the tech sector to really start outperforming and continuing this rally that it's had versus the Russell post-earnings is probably quite unlikely, right? So I would suspect you're going to continue to get stronger economic data. You're going to get strong earnings out of this earnings season, and this kind of value growth trade may well resume, right? So it's got potential, whereas the markets haven't had a pullback. People who are looking for a pullback in the market saying, I can't buy it up here, it's at all-time highs. Well, you look at that trade, arguably that is a cyclical expression to get long risk, to get long, the recovery trade, and that's had 11% pullback. So some things are pulling back, right? You just got to know where to look. So that might be an interesting entry point to put on that type of trade. Now, maybe you don't sell the tech because you're scared to sell the tech, because that often tends to be bulletproof as well. But it's just telling you there's more value potentially in buying the Russell than there is in, say, buying the Nasdaq at these levels, right? So something to be aware of. Yeah. India. So I've been a fan of India for a while, as you know, but they haven't had great data recently with regards to COVID. Right, so they've had record levels in terms of the COVID cases, and they've overtaken Brazil as the second highest number of cases, right? So on the back of that, they've introduced more restrictions, and the market took a bit of a wobble over the weekend, dropped about 3.5%. Now, the Nifty chart, it kind of got to some quite key technical levels. So just on a short-term Fibonacci, we basically got down to that 14.3 level. It's bounced quite well off that. It's bounced like 200 points off that already overnight. So for now, it's held on to that key 14.3 level. But watch this space, right? I mean, if things continue to deteriorate in India, then maybe it's got some more downside. Like I say, the technicals, the long term look great on this. So if it wanted to have a bit more of an extended pullback, it's not the end of the world. But it's just, the COVID situation not looking great right now in India. Yeah. Also, Brazil has been, a place of weakness for a while on that front, and that they've got multiple issues with their economy. And Brazil markets are still showing signs of weakness. So if you look at the stocks, EWZ is the kind of ETF that I keep an eye on there. That's basically failed at a resistance level. Again, it really struggles to break above that 34.5 area. So, and it's showed a bearish momentum divergence when it failed at that level again. And you've also had the currency, which I have been mentioning over recent weeks. Currency still remains weak against the dollar and is in this kind of precarious triangle formation, which if it were to break to the upside, could give it the impetus to sell off quite a bit more and go into that sort of 6 territory, right? So Brazil and India are definitely showing some signs of weakness right now. Yeah. So that's kind of it for equities. In terms of yields, you've had some stabilization, signs of stabilization on yields. If you see here, which has kind of been ranging right in that sort of 178 high to 158 low area. So kind of in no man's land, tracking the average, sort of sitting there at the 20-day average. It's not really a lot going on yields. Arguably, if that CPI data had come out strong, there was room for this thing to break to the upside. But for now, it seems quite benign and quite in line with expectations, that CPI number. Obviously, a break through 178, triggers the next move. And obviously, the 2% level would be your sort of target area for the next kind of charge in that space. Lots of US Treasury issuance on its way, about 370 billion coming over the coming weeks. You had the 10-year and 3-year auction yesterday. What you're looking for is foreign buying demand, right? You want foreigners to soak up this issuance. You're looking at the data that came out of the auctions yesterday. Bid to covers was slightly below 1-year averages. Indirect bids, which is basically foreign buyers, were slightly below 1-year averages, but not horrendous. So those auctions kind of were all right. You've got the 30-year auction today, and it seems like the 30-year tends to be a bit weaker than those shorter dated maturities, right? The longer the duration, it's almost like the harder it is to get these guys to take it down. So yeah, keep an eye out on that. The Fed's Bullard signaled that 75% vaccination rate could be sufficient to start tapering. So what's on everyone's mind is, the Fed's going to let inflation run hot, then they're going to lose control of it, and then they're going to have to taper and raise rates, blah, 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 right? Those are the fears. And Bullard's basically trying to put some numbers on that finally, and saying that once you get 75% vaccinated, you potentially start talking about tapering, right? So if you look at the rate of vaccinations in the US, you can extrapolate that might mean that in 3 months' time, we're pretty close to that number. So that's when the Fed's going to be talking about tapering, which basically means the June FOMC meeting could be quite important, because we're not going to be that far away from that point in June. So the market's going to be asking questions about tapering. And the question is the Fed going to actually give us something, right? So June FOMC is going to become a bit of a market event, right? So that's kind of my thoughts on yields at the minute. Coming up this week, what else have we got? Well, like I say, today we've had CPI come in. We've had a low ZOO print out of German business confidence was a bit lower than expected. And we had Chinese trade data, which was not too bad, quite good actually, right? What have we got tomorrow? Fed speakers, including Powell. We've got US bank earnings kicking off. So you've got Wells Fargo, JP Morgan, and Goldman's tomorrow. You've got Thursday retail sales, US retail sales, industrial production, Empire Manufacturing, so loads of macro data. You've got Bank of America and Citi earnings. And on Friday, you've got Chinese GDP and a bunch of data out of China, and also US Michigan sentiment, consumer confidence, right? So quite a few data points coming out for the rest of the week. And then one final thing, which we'll talk a bit more about later, is the Coinbase IPO. So you've got Coinbase IPOing tomorrow. Everyone in the crypto space is talking about it and keeping an eye on it. How will it really? It won't impact broader equity markets, but it is something to keep an eye on. It's likely to be quite volatile. Some of these IPOs can wang around quite aggressively. So just sort of have a look at that and see if that gives you any read on general sentiment within crypto. Yeah. Okay, so that's kind of what's coming up this week. If we then move on to FX. DXY has been very stable, very benign, kind of drifting slightly lower, but not on any volatility. So pretty stable to slightly softer. Not really a lot to say there. I suspect, like I said, I kind of already said, I suspect it could drift a bit lower. I said that last week, but not aggressively. And I think, as long as yields are headed higher, which I think they probably are in the US, that's going to be supportive for the dollar in the next sort of month or two. Euros kind of was hovering around 119. It's kind of trying to break above it right now, but it's got some overhead sort of resistance up here at around 119.5 area. Whereas sterling's kind of parked itself on that lower support region around 137.20. So that's kind of an area of support, that 137.20 area. I don't have strong opinions on these currencies, but what I would say, given that sterling's kind of at what looks like a reasonable support level and euros at what looks like a bit of a resistance level, maybe euro sterling is the trade here. So if you look at euro sterling, it's had a decent pop off its lows, like near 85. It's got all the way back to 87. If you look at the kind of general trend to the downside since last year, it's kind of popped its head up towards the top of that sort of downward sloping trend channel if you take out some of those excess moves. And it's also at the top Bollinger Band. So for me, a tactical short on euro sterling around 87 with a tight stop around 87.5 to play a move to at least 86 and maybe back towards those lows. If you believe in the whole sort of UK optimism on the reopening story that we're going to get over the coming weeks, then that might be an okay, relatively safe way to play that story, right? Another way to play that story is FTSE, which we didn't talk about in the equity section. So I'll quickly bring up the FTSE chart. But basically, FTSE's kind of been a bit of a laggard in terms of the major equity markets. It is still quite unloved. It is still quite good value in terms of the fundamentals, because people just steered away from UK assets on the back of Brexit, things like that. So potentially it offers some value. 7,000 is quite a big level on the FTSE. If it takes out 7,000, you've probably got legs to around 72, 73, fairly sharpish. And the volatility in FTSE is very cheap, right? So generally FTSE trades at one of the cheapest implied vols in Europe because it doesn't generally move as much. But those calls, you can buy those upside calls in May or June on like an 11 vol. And they can offer you fairly decent leverage if you think there's an upside break coming, right? So again, if you're looking for ways to play risk on and equities rallying over coming months because you still believe in the recovery story, but you haven't got a dip in US equities, then the kind of places where you need to be looking are China tech, it's got beaten up. Is that going to bounce back? FTSE still value and could benefit from a UK sort of spending boom in the summer. And then you've got that sort of Russell versus NASDAQ spread showing you that there might be some juice in that mid-cap trade in the US, if you believe in the recovery story, right? So those are kind of the places to kind of look for within equities where there might still be some value. Okay, so that's kind of it in FX. Then in commodities, general commodities have been quite boring. I think gold's the only one really worth talking about. So you've had gold pop all the way up towards that 1760 level that we've been flagging as the kind of key resistance. All right, so gold had been managed to get pretty close to that key resistance at 1760 again. It had managed to do it with a bearish divergence and it's failed at that level. So we saw, I mean, earlier today we saw about 1725, but we've actually popped now back to 1745 post the CPI number. So, I mean, gold's kind of winging around a little bit, but it's still staying within its range. You know, I've been generally building up, re-entering shorts around this level and slightly higher with the idea that as long as we don't break 1780 to the upside, then I expect the kind of downtrend within gold to continue. And I ultimately expect some sort of break of that 1670 level to the downside. If we get our recovery story, we get real yields continue to go higher into the summer. These are the fundamental drivers that I'm looking for to get the gold sell-off going again, basically, right? So nothing really changed in that fundamental view. Now, the one thing that would make me a little bit wary is, so this is showing us, they've got gold newsletter sentiment index. So, you know, there's a lot of stuff that's written about gold, right? So this kind of index is like tracking the sentiment around the gold market. And then it tries to see if that gives you a read on kind of, or where gold mining stocks then ultimately go, right? So I you know, I haven't seen this before, but I kind of saw this week and I found it quite interesting. So we are at, you know, a really, really low point in terms of sentiment for gold. And if you look at that previously, when it gets this low, it often signals a bit of a low in the gold miners. So like the GDX ETF, right? So it's just something, even though the fundamentals do look pretty bad for gold, it's just something to be aware of, that sentiment is pretty beaten up, right? So, you know, what I'd like to see is, you know, an overshoot to the downside where that sentiment really goes to crazy levels. And then we can have a level in the gold price where we're comfortable getting long again and sentiment's really beaten up. But right now, for me, we're not at a level in gold price that's so low. I think it does have further downside and I think the fundamentals will move in that direction. But it's interesting to see how beaten up the sentiment is. So what I would say is, you know, I'm all right being short gold right now. I'd run, like I said, I'd run a stop around probably 1780 on any shorts. But if we do start to break to the upside, then the thing to buy is probably gold miners because they're the ones that can really have some beta to a recovery in gold. And based on sort of what this chart is kind of saying, that's kind of where the opportunity might lie, basically. Right. So something to keep an eye on. You know, like I said, if you're a long-term guy who wants to pick up gold, maybe you already start buying things like Barrett Gold or whatever the ETF GDX and things like that. But look, I'm playing gold tactically from the short side right now. And I haven't really bought any miners yet. I mean, I've got some miners from years ago that are in my long-term portfolio, but I haven't added to any miners yet. But it's something I'm thinking about. Like if it does start to break 1780 and it looks like the gold bottom is in for now, then I might actually get involved with some of these miners because they might have some legs to run to the upside. Yeah, so something to keep an eye on. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.